Hi everybody, my name is Shobhat and today we're going to talk about a very interesting book called as Value Investing and Behavioral Finance. Imagine this, you lost your money not because any economic crisis happens and not because a company becomes bankrupt. It's just because you made a bad decision. Yes, you heard it right. You made a bad decision, and it is not because you are dumb. It is because how human nature, human brains are wired. And this book works on the two levels. Number one, it shows your hidden biases and blind spot that you think you never had it. And on the second hand, it shows you the proper guidance and roadmap that how you can become a successful investor. Now, let's first look at the how, why humans take such decisions. Let's look at the human nature. Humans are lazy, ambitious, ignorant, greedy, and they all strive for security, comfort, love, and leisure. Now, this takes us to the three major problems that investors are not questioning their strategies. Let's say they incorporated a particular strategy and they are incorporating that same strategy for all the investments, and that is creating a loop, and they are stuck into it and calling themselves an unsuccessful investor. And the second one is unwillingness to delay gratification. For example, let's say a boy who dropped out from a college just to impress a girl earned enough money and impressed that girl. And the long term result will be he is going to be a low earner for his entire life. And the third one is very interesting, loss aversion, the psychology of risk. Now, this Devin Decision Lab research report also proves that the pain of loss is 3x more than the joy of gain. And let me explain this with an example. Let's say you invested a 10,000 rupees on a first investment and you invested 10,000 rupees in second investment, totally 20,000 of investment. So on the first investment, you gained 10% of return. And on the second investment, you gained a 8% of return. Cumulatively, you earned 18% of return. But you are in a more regret that if you would have invested the second investment of 10,000 rupees in first only, you would have gained 2% more, total 20%. That's where the 2% of loss is giving you much more pain than the joy of 18%. This is what the loss aversion says. And Parag Parikh sir in his book given a simple example with all these problems. That is, you have to align your EQ and IQ so properly with discipline that you can see your hidden biases and hidden traps so that you can invest properly and become a successful investor. Now, if we are clear about how human thinks and how we have to invest, let's look at the equity market, why Sensex are so volatile and why it is booming and hit rock bottom on the same time. For that, I would like to call Hardik.
Parak sir says, we all think that equity is risky, whereas debt are safer. But when inflation comes into picture, the debt become more riskier. As debt has given return of 10.4% per annum between 1979 to 2007, whereas at the same time equity has given a return of 19.67% per annum. Then why investors find equity riskier? The answer lies in understanding investor behavior and its effect on stock prices. The debt has only one return, that is interest income, whereas equity has two sources of income, which are fundamental and speculative. When the market is in bear run, the irrational investor will sell equity at fundamental prices or even lower, and value investor will purchase it. And later, at full phase, this irrational investors get ready to purchase the equity at higher than fundamental prices, which blast value investor with exit options. 90% people follow the physical way and they work very hard in gaining information and ended with information overload. They think that there are many opportunities in the market, but good opportunities comes once in a while. 10% follow the emotional way and get a good return because they buy when they emotionally do not feel like buying and sell when their heart and say no, but the mind and logic say yes. Next slide, please. Heuristics is a rule of thumb which propose to explain how people make decisions, come to judgment, and solve problems typically when facing complex problems or incomplete information. Some of valuation heuristics are PE ratios, price to book value, price to sales, instant gratification. It says that value investors require patience and take longer to get the results, whereas investors seeking more immediate abnormal returns because of the fear of short-term underperformance and perhaps loss of bonus or even a job. People are not able to sell the loser stock and instead buy it more with the hope of its appreciation. And in case of winner stock, we sell it too early for taking profits, which results in holding off losers and selling the winners in our portfolio. Institutional investors, instead of knowing, make mistakes because they prefer to fail with crowd instead of getting fail alone. As they are too much concerned about their images, losing money on well-known company in which all had invested is okay, then investing in company which is not well-known and make loss. For any stock to be a growth stock, it should be first value stock. Value and growth are inseparable. Investors get ready to pay higher valuations just because of the future growth expects without the analysis of the impact of growth on the value of the company. The concept of growth stock is a product of a bull market. It dies when the bear market sets in. Bear markets creates values. People remember what happened recently and don't remember the long-term picture due to which companies which are doing very great right now attracts people which are growth stocks and investors get attracted towards the clamor of growth stocks more than value stocks. Next slide, please. Value investing is superior to growth investing, as it is based on strong company fundamentals, while growth investing often attracts investors through market hypes and momentum. Value investors buy stocks below their intrinsic value, whereas growth investors usually pay premium prices seeking quick gains. Value investing requires patience, discipline, and independent thinking, while growth investing is often influenced by herd mentality and short term trends. It also recognizes that company growth does not always guarantee investor returns, as cost of capital matters. Overall, value investing offers consistent and long term wealth creation, while growth investing may lead to temporary gains but higher long term risk. Now, I would like to pass the presentation to Tirth Chain.
Hi, my name is Tej Jain. I'll begin with the contrarian investing. The idea is simple. The best opportunities come when the majority is wrong. Markets are generally efficient, but in the short term, human emotions like fear and greed create mispricing. This is where the contrarian investors act. They invest in low PE, ignored, and pessimistic stocks instead of chasing popular high PE names. But this approach is not easy. Biases like herding, false consensus, and recency effect push investors to follow a majority and chase recent winners. Now, if we compare the conventional portfolio, which consists of top 10 high PE Sensex stocks, with the contrarian portfolio, which consists of top 10 low PE Sensex stocks over the time period from 1996 to 2006, we can see the difference very clearly. The conventional portfolio, which follows the herd, is more volatile and suffers during downturns, while the contrarian portfolio shows steadier growth and better long term performance. So, the key lesson for the investor here is real wealth is created. Real wealth is created not by following the noise, but by acting when opportunities are ignored. Next slide, please. Now, this brings me to the second concept, growth trap. A growth trap happens when investors overpay for growth. We often get attracted to companies showing high growth, but the price we ignore whether the price we are paying actually justifies that growth. This happens because of behavioral bias, for example, availability bias, where investors chase trending sectors, and the halo effect, where one strong factor like growth makes everything looks attractive. But true investing lies in balancing quality and valuation. Before investing, we should check management quality, business sustainability, cash flows, and most importantly, where valuation is reasonable. Successful investing is not about chasing growth or following the crowd, but about discipline, valuation, and patience. Because in the end, price is what you pay, but value is what you get. Now, the next header will be taken by my colleague Fozia.
Hello everyone, I'm Fozia Mariwala. I'll explain how commodity investing works and why timing the cycle is so important. Unlike normal stocks, commodity companies don't just grow steadily. Their performance is driven by prices cycle, meaning prices go up and down in predictable phases. Let's walk through the cycle. It starts with the boom phase. Prices are high, so companies expand and build new capacity. But that leads to oversupply, pushing us into the decline phase where price crashes. Next comes the trough phase. Weak players exit, supply shrinks, and the market becomes tight again. Finally, we enter the recovery phase where demand picks up, the next boom begins, and this cycle keeps repeating. Most investors get this wrong because of bias. They assume current high profits will continue forever, right before the crash. So remember, in commodities, what looks cheap can actually be risky, and what looks expensive can be an opportunity. Next slide. Next slide. Here's how the steel industry behaves in commodity cycle using Tata Steel and JSW Steel. During the boom, JSW expanded aggressively using debt. Its debt to equity crossed 2.4 times, and interest coverage dropped close to 1, meaning most profits went into paying interest. When the downturn came in 2015-16, JSW suffered losses. This shows how high cost, high debt companies struggle in bad times. In contrast, Tata Steel had a cost advantage due to captive iron ore mines. It maintained moderate debt and stronger financials. So, during the downturn, Tata Steel not only survived but became stronger and even acquired Bhushan Steel. In commodity cycle, low cost producers survive, high cost one suffers. Next slide. Next slide. Let's understand why PSUs can be an hidden opportunity. Companies like ONGC, Coal India, NTPC own irreplaceable natural assets. They have three big advantages: exclusive ownership, strong government backing, and steady demand with pricing power. Back in 1994-1995, the government sold PSU stakes at very low prices due to market pessimism. But investors who saw the real value made huge returns. Markets often ignore PSUs because of fear and not fundamentals. So PSUs may look boring, but they can be powerful long-term investments. Handing over to Vivan.
Hi, so coming on to my slide, sector investing opens with a very simple but powerful observation. Every bull market is led by a different sector. IT in 1999, real estate in 2007, infrastructure in 2008, and every time investors rush in. But here's Parikh's core argument. By the time a sector becomes popular, the opportunity is already priced in or overpriced. The approach most people use is called the top-down approach. You identify a hot sector, pick companies within it, and invest. Sounds logical, but the problem is everyone is doing the same thing. Prices inflate far beyond what the business actually justifies. It's momentum dressed up as research. And six behavioral biases makes this worse. Representativeness. Investors assume every company in a hot sector will do well. Availability heuristic. Constant media coverage makes the opportunity feel obvious. High herd mentality. Nobody wants to sit out of the rally. Anchoring. Recent high returns feel permanent. Winner's curse. Companies overpay for acquisition at the peak. And confirmation bias. Once invested, only good, now new registers. The classic Indian example Parekh gives is of Tisco acquiring Chorus, a massive debt funded deal made at the peak of a steel boom driven by overconfidence and not fundamentals. Moving on to the next slide. Now, how does a sector bubble actually form? Parekh breaks it into six stages. The sector starts with genuine growth. Media hype builds, everyone piles in, IPO explodes, the sector waits in the index surges. And that is the warning signal, not a reason to invest more. And then the bubble bursts, fast, violently, and late entrants are trapped. His most counterintuitive lesson. The sectors nobody talked about are where the most returns are. FMCG and healthcare, boring, overlooked, consistently. Compounded better than the existing factors. IT crashed, real estate crashed, FMCG quietly compounded. The rule is simple. Sector bubbles are exit signals and not entry signals. Moving on to the third slide. IPO. Initial public offerings, and the data Parikh presents here is devastating. He studied 3,122 companies IPO listed in India between 1991 and 2006. Over 50% of those companies simply vanished, delisted, bankrupt, or merged. Of the survivors, 56% gave negative long term returns, and only 15% actually beat the Sensex. So, who really wins from the IPO? Not you. Angel investors who backed the companies year before listing, higher returns, venture capitalists who entered early at a discount, strong returns, and retail investors who buy at the IPO. They are funding everyone else. His conclusion is clean. IPOs are product of bull market. Companies list when they can get the highest price, not when you can get the best deal. If the company is genuinely good, it will still be available in the secondary market at a better price with more information. The value investor has no urgency to participate in any IPO. To summarize, hot sectors and new listings feel like opportunities. Parag Parikh's data shows they are usually traps. The real edge is in buying what others are ignoring at prices that reflect business value, not market excitement. I'll now hand over to Krisha.
Now let's talk about the illusion of index investing. At first, index investing seems like the smartest and the safest strategy. Low cost, diversification, and no need to actively pick stocks. It sounds perfect, but the reality is more complex. As explained by Parag sir, index investing is driven primarily by market capitalization, not by the actual quality of a business. This creates a fundamental flaw. A company gets included in an index not because it is fundamentally strong, but because its strong price has rise, its market cap has become large, and it has become popular among the investor. So indirectly, when we invest in an index, we are often buying what is already expensive, following the crowd at its peak. And because of this, it's create laggard phenomena. Whenever a stock is added to the index, institutions rush to buy it. Demand increases and price rise further. At the same time, stock removed from the index are ignored and their price fall or remain stagnant. Over a long time, the ignored stock actually outperform the popular one. In fact, the study shows that rupees 10,000 invested in laggard stock grew to around rupees 78 lakh, while the same investment in newly added stock grew to only rupees 31 lakh. This clearly proves one thing: return depends on the price you pay, not on the popularity. Next slide. Anatomy of a bubble. A bubble does not start with the stupidity. It actually starts with a valid idea. For example, technology bubble in 2000, real estate and infrastructure in 2007. These ideas are real and powerful, but the problem begins when the investor take a good idea too far. And this is how a bubble is created. A valid foundation, a genuine growth story exists, something promising and exciting. Second, bandwagon effect. Early investor makes the profit and others join in, driven by FOMO and envy. Third, media hype. News channel, experts, and social media amplify the story. It becomes a must invest opportunity. And fourth, greater fool theory. Now people stop thinking about its value. They buy with the belief, I will sell this to someone else at a higher price. And this is where the bubble becomes danger. Bubbles are not created by the data, they are created by the human behavior like overconfidence, greed, herd mentality, and most importantly, the belief that this time it is different. But the history shows every time the ending is the same. We can identify bubble by looking at the market conditions. Stock market is growing faster than the actual GDP. P ratios are extreme and unknown firms are entering the market. So investors should focus on first, valuation always matter. No growth story can justify an unlimited price. Second, avoid chasing hot stock or trending sector. Third, develop the courage to think independently because in investing, success doesn't come from being right with the crowd. It comes from being right against the crowd. Now I would like to pass on to the Daksh to continue the presentation.
Let's start with two very common psychological biases that affect investors: self control bias and present bias. Self control bias is when people make good financial plans but fail to stick to them. For example, preferring immediate gratification over long term goals. This often leads to overspending, poor saving habits, and weak discipline, which ultimately hurts wealth creation. Present bias is closely related here. Your people give more importance to immediate rewards and undervalue future benefits. This encourages spending instead of saving or investing and often result in regret and financial stress later. Another important concept here is mental accounting, where people treat money differently depending on its sources. For example, someone might spend a bonus freely but save their salary carefully. Even though all money have the same value, This leads to inconsistent financial decisions. These biases have real consequences in investing. They can lead to inadequate retirement saving due to poor planning. Investors may make irrational decisions driven by emotions such as panic selling during market downturns. There is also a tendency to focus on short term profits instead of long term growth, which reduces overall returns. In short, emotional and impulsive decisions often override logic in financial markets. Next slide. Okay. Because of these biases, investors commonly make a few key mistakes. First, selling winners too early. Fear of losing profits causes investors to exit too soon, missing out on long-term compounding. Second, holding losers too long. Investors hold on to losing stocks, hoping they will recover, which ties up capital and increases opportunity costs. Third, trading too frequently. Overconfidence leads to excessive trading and transaction costs and taxes eat into returns. And finally, overconsumption and under saving, spending too much today and saving too little for the future. Next slide. Key behavioral. Okay. Timeless investment principles. Now let's look at some timeless investment principles. First, price is what you pay, but value is what you get. The difference between the two is your margin of saving. Second, valuation always matters. No matter the story or hype, a company is only worth the cash it can generate over time. Third, patience is the ultimate edge. Markets take time to reflect true value. Fourth, go against the crowd selectively, not blindly, but when the crowd is clearly wrong. Fifth, EQ is more important than IQ in markets. Emotional discipline matters more than raw intelligence. And finally, always understand before you invest. If you can't clearly explain why you are buying something, you are likely speculating, not investing. Okay. To conclude, markets are driven not by just fundamentals, but also by human psychology, fear, greed, herd behavior. The greatest edge in investing is emotional discipline, aligning both IQ and EQ. Valuation always matters regarding of the market narratives, and mostly important, the investor's biggest enemy is often themselves, their own biases and impulses. As Benjamin Graham said, the investor's chief problem and even its worst enemy is likely to be himself. Thank you.
Let's go, bhai. Let's go.